Welcome back to the deep dive. We are doing something a little different today. Usually we take a broad topic and try to, simplify it.
We boil it down.
Exactly. Today, we're flipping that. We are taking a topic that sounds simple, sales. And we're going to expose why it's it's one of the most complex, headache-inducing logic puzzles in the entire corporate world.
That's a good way to put it.
We are looking at the nervous system of enterprise business. SAP Sales and Distribution, or SD, as everyone calls it.
It's funny you call it sales because when most people hear that word, they think of a guy in a suit, shaking hands, maybe buying a steak dinner and closing a deal.
Right, the front-end stuff, the glamour.
But in the SAP world, that handshake, that's maybe 1% of the work. The other 99% is everything that has to happen after the handshake to make it real.
Right, and that's our specific mission today. We are not talking about how to, say, enter an order or how to make a customer master record. We're looking at the friction points.
Breaking points.
The moments where the whole process just breaks down. We're really digging into the journey from sold to cash in the bank.
Which, believe me, is rarely a straight line. It's more like a winding mountain road with lots of potential cliffs.
Exactly. We have a massive stack of notes here, and we're covering everything from the nightmare of revenue account determination, which sounds boring until your CFO starts screaming.
Oh, it gets exciting very quickly then.
To the legal traps of tax determination, credit risk, and even some of the dark arts of technical debugging.
And we absolutely need to look at this through the lens of integration. I think that's the key theme today.
Why is that so critical?
Because SD doesn't live on an island. It just doesn't. It feeds finance, it triggers materials management, it directly impacts your compliance reporting. When you see a billing error, it is almost never just a billing problem.
It's a symptom of something deeper.
It's a symptom of a disconnect in the underlying logic that probably stretches all the way back to how someone set up a material master record 3 years ago and forgot to check one box.
So let's set the stakes for everyone listening. I want to paint a picture. Imagine you're a sales director. You've had a record quarter. The team is celebrating. The goods have left the warehouse. The customers are happy. The trucks are empty.
Everyone's getting their bonus.
They think so. But then you walk into a meeting with a controller, and she pulls up a report and tells you that according to the general ledger, you've sold absolutely nothing. The revenue line is flat.
Or, and I've seen this happen, the revenue for your high-end multi-million-dollar hardware is somehow sitting in the scrap sales GL account.
Oh, no.
Talk about a margin killer.
Or here's an even more terrifying one for the notes. You've issued invoice number 100, then the next one is invoice 105. And now the French tax authorities are knocking on the door asking, very politely at first, what happened to invoices 101 through 104?
That sounds like a prison sentence waiting to happen.
Is that an exaggeration?
In some countries, it literally is. Invoice continuity is not a suggestion, it's the law. A broken sequence implies you're hiding sales.
Wow. Okay, so let's start exactly there, at that money moment. The point where a sales order stops being a promise and starts becoming a financial reality. We're diving into billing and accounting integration.
This is Chapter 5 in the material, and honestly, if you get this part wrong, nothing else matters. It's the most critical link in the chain.
Let's tackle that wrong bucket problem first. How does the system actually know where to put the money? I have to assume there isn't a room full of accountants manually typing in GL account numbers for every single invoice line that gets generated.
No, absolutely not. That would be impossible at any kind of scale. The core mechanism that handles this is a transaction code called VKOA.
Okay.
It stands for Revenue Account Determination. And the best way to think of VKOA is as a massive, intelligent railway switchboard.
I like that analogy.
Trains, which are your sales dollars, are coming down the track at high speed. And VKOA has to decide, purely based on the train's markings, which track to send it down. Does it go to domestic revenue? Does it go to services revenue? Maybe third-party hardware? Or freight reimbursement?
So it's all about routing the money to the right place in the general ledger.
Precisely. It's the brain that connects the sale to the financial books.
So what are the markings on that train? What does it look at to make that decision?
It looks at a combination of keys. It's a very flexible system, but the two most important, the ones used 99% of the time, are the account assignment groups.
Okay, account assignment groups, where do those live?
You have one on the customer master record, usually on the billing tab of the sales area data, and you have another one on the material master record in the sales org2 view.
Okay, so the system says this specific customer has the tag foreign, and this material they're buying has the tag service.
Exactly. And then it goes to the VCOA switchboard, and VCOA has a rule that says, condition, foreign customer plus service material, send to GL account 400-020. It's basically a big if-then mapping table.
That sounds pretty robust.
Yeah.
It feels like it shouldn't go wrong if you set it up correctly, so why does it?
It goes wrong because humans are involved in setting up those rules and, more importantly, maintaining the master data. Let's say you have a billing document and the revenue hits the wrong account. Your controller's on the phone. How do you figure out why? You can't just guess. You have to use what I call the detective tool.
The detective tool? What's that?
It's built right into the system, transaction VS02. You pull up the billing document that failed, go to the environment menu in the header, and select account determination analysis.
I think I've seen this screen. It's got a bunch of tables, and some of them have little red or green lights next to them.
That's the one. It looks like a traffic light system. It's showing you the access sequence. This is the hierarchy of rules the system checked, from most specific to most general.
So it tries the most detailed rule first.
Yes. It might look for a rule for customer group A buying from sales org B with material group C. If it sees a red light, that means it didn't find a rule there. So it moves to the next level down, maybe a little less specific. When it finally finds a green light, that's where it stopped and grabbed the GL account.
So if you're debugging, you just look for the green light and see what rule it picked up. Seems simple enough.
Ideally, yes. But here is the trap. The source material warns about this very clearly, and it's something I see all the time. It's the general entry trap.
The general entry trap. This sounds like the laziness factor you mentioned.
It's the safety net factor, which is born from good intentions but causes terrible problems. In VCOA, you can set up a rule that is incredibly vague, unbelievably general.
How general are we talking?
You can set up a rule based only on the chart of accounts and something called the account key, which just says, this is revenue, no customer group, no material group. Basically, the rule is, if there's any kind of revenue and you can't find any other rule, just put it here.
That sounds like a good idea, though, right? As a fallback, to prevent errors from stopping the process.
It prevents the posting error, yes. The document will save without a hard stop. But what it creates is a reporting disaster.
How so?
Because the system, like you said, is lazy. It's efficient. It will check all the specific rules. Let's say someone created a new product line and forgot to maintain the account assignment group on the material master. The system looks for a specific rule, fails again, falls all the way down to the bottom of the access sequence, finds that super general rule, gets its green light, and then dumps the money into a generic miscellaneous revenue bucket.
So you think you're fine because the invoice went out the door? The customer got their bill?
Right. Everyone moves on. But at the end of the month, you run your profitability analysis by product line, and you have $5 million sitting in an account called miscellaneous revenue with no detail. And trying to unscramble that egg to figure out which sales belong to which product line after the fact is an absolute nightmare for the accounting team.
So the advice is, don't use these safety nets if you care about your data quality.
Or if you do, you need a report that monitors that miscellaneous GL account every single day, like a hawk, looking for things that don't belong there.
Okay, that makes a lot of sense. Let's move to another headache that I know drives sales reps and accounts receivable teams completely crazy. The split invoice.
The bane of every AR department.
You have one big order. The customer wants one big, simple invoice. But for some reason, the system decides to slice it into 5 different pieces. Why does it do that? Why can't it just create one?
Well, there are 2 main flavors of this problem. There's the we had to do it split and the we were told to do it split.
Let's start with the had to, the one we can't control.
Okay, that's the 9999 line item limit. This is a hard technical constraint deep in the SAP database architecture for the financial accounting document. The FI document, the thing that actually hits the general ledger, simply cannot have more than 999 line items.
Wait, really? In this day and age of big data and cloud computing, we are limited by a 3-digit counter from the 1980s.
It's legacy architecture, but it's so deep in the kernel, changing it would be like trying to change the foundation of a skyscraper while you're on the top floor. It's not happening.
So if a customer places a huge order, say for 2,000 different spare parts,
the system has no choice. It must split that into at least 3 separate accounting documents. If it tried to shove 2,000 lines into one FI doc, the database update would fail. You'd get a system crash, a short dump, and nothing would post.
so that's non-negotiable.
Completely non-negotiable. But to be fair, that's rare for most companies. The much more common reason for splits is the other one, Business logic.
We were told to do it split.
Yes. The system splits invoices because the data in the header of the billing document must be identical for all items being billed together. This is the golden rule.
Okay, explain what that means in practice.
Think about a physical piece of paper, an invoice. It has one header section at the top. It has one bill to address, one set of payment terms, one billing date. It can't have two.
Right, that's logical.
So if you have a sales order where line item 1 has payment terms of net 30 and line item 2 has payment terms of immediate payment required, physically, they cannot exist on the same piece of paper. The header can't say two different things at once.
So the system splits them to preserve the logical integrity of each document.
Exactly. It's preserving the truth. The most common culprits that cause this are different pairs, different payment terms, different Incoterms, or different billing dates. If any of those header-level fields are different between two items, boom, you get a split.
But what about the really frustrating ones, where you look at two invoices side by side and everything looks identical? The payer is the same, the date is the same, the terms are the same, but it still split them. That's the ghost in the machine.
That is almost always the ZUK field.
Zukri. Sounds like a Bond villain.
It might as well be. It's a technical field name, it's not on the screen, but it represents the split logic criteria. In the background, in the copy control configuration, that's the set of rules that tells the system how to copy data from a delivery to a billing document, there is a program, a routine. Usually it's routine 001 or 007.
And what does this routine do?
This routine's job is to fill the ZUKRI field with a string of data, a combination of values from the order or delivery.
So it's a hidden combination key.
Precisely. It might be programmed to combine, say, division plus distribution channel plus sales office, or something even more obscure. If anything in that hidden string is different between line item 10 and line item 20, the system sees two different ZUKRI values and forces a split, even if everything on the screen looks the same.
So how on earth do I find out what's causing it? Do I have to call a developer and have them debug the code?
You don't, and this is a huge tip. You can do it yourself. In transaction VS01 or VS04, when you are trying to create the bill, there is a split analysis button or menu path.
I feel like almost nobody knows about or ever presses that button.
They don't. It's one of those hidden gems. But if you're facing a split and you run the analysis, the system will put the two potential invoices side by side and highlight in yellow the exact field that contains the different value.
So it just tells you the answer.
It tells you the exact culprit.
Yeah.
It might be something absurdly small, like the exchange rate is different by 1/100 of a penny because the items were goods issued on different days. The split analysis tells you the unvarnished truth.
That is actually incredibly useful. Okay, let's level up the difficulty. We've figured out how to get the money in the right bucket and how to get it onto one invoice. But now we have to talk about intercompany.
Ah, yes. The ultimate reconciliation nightmare.
Why is this so hard? Conceptually, it seems simple enough. Company A sells it, Company B ships it. What's the big deal?
It's hard because you are trying to make two different, separate legal entities agree on the financial reality of a transaction instantly and automatically. And in the world of SAP, intercompany isn't just one thing. There are two very distinct flavors, and people confuse them constantly, which leads to all sorts of problems.
Okay, give me the breakdown. Flavor one.
Flavor one is the cross-company sale. This is a true revenue event involving an external customer. A customer places an order with Sales Org A, let's say that's your U.S. company, but Sales Org A doesn't have the stock, so the system is configured to source it from a plant that belongs to Sales Org B, which is your German company.
So the customer in the U.S. gets one invoice from the U.S. company.
Yes, as far as the customer is concerned, it's a simple transaction. They get a standard customer invoice, an F2 invoice, from the U.S. entity. But behind the scenes, a second transaction has to happen. The German company has to bill the U.S. company for the cost of the goods. That's the IV invoice, the intercompany invoice.
Okay, two billing documents for one sale. Got it. And flavor two.
Flavor two is the intercompany stock transport order, or STO. This is not a sale to an external customer. This is purely an internal transaction. Your U.S. warehouse is running low on stock, so they raise a purchase order to buy 1,000 units from the German warehouse just to replenish their own inventory.
So just moving inventory between your own warehouses.
It feels like that, but because it crosses company codes, it's legally a sale. The U.S. company is buying from the German company, so you need a purchase order on the U.S. side, a delivery on the German side, and again, that intercompany invoice type 4V to charge the U.S. for the stock.
So where does this whole process usually break down? Where are the common failures?
Pricing and tax. Almost always. It's one of those two.
Okay, let's talk about the pricing failure first. That seems critical.
It is. In the intercompany invoice, the high V document, you are not charging the external customer market price. You are charging an internal transfer price. Maybe it's cost plus 5% or some other value agreed upon by the two companies.
Right.
To do that, your intercompany pricing procedure needs specific condition types designed for this, usually PI01 or PI02 for the transfer price.
And if those are missing from the configuration or the master data?
Then you get an intercompany invoice with a value of 0. Which is bad. Or even worse, the system fails to find the intercompany price and it defaults back to using the customer's price. And suddenly your German company is billing your US company the full retail price for the goods.
Which would completely wipe out all the profit margin for the US division on that sale.
Exactly. It creates a massive artificial loss in one company and a massive artificial profit in the other, which leads to a very angry controller in the US and some very confusing financial statements.
And this all leads, I imagine, to the reconciliation nightmare.
This is the classic SD versus FI battle. It happens every month and closing period in thousands of companies.
So sales thinks they've done their job, but finance has a totally different view of the world.
That's it in a nutshell. SD reports, like transaction MC plus E, they track sales. They track the order. The moment the order is booked, it shows up there. But FI reports, like FBL5N, which shows customer line items, they only track postings. They only see the world after the invoice has successfully passed through that gateway to the general ledger.
And there's a gap between those two events.
A potentially massive gap. You might have created the billing document in SD, the invoice number exists, the PDF was sent to the customer. But because of a posting block or a GL account error, like we discussed earlier, the data never actually flowed to FI.
So SD thinks the month was great, and FI thinks the month was terrible.
And both are technically right from their own perspective. This is where you have to live in transaction VFX3.
VF3, what is that?
It is the blocked billing documents report. I call it the purgatory of SAP. It is a list of every single invoice that has been created in SD, but for whatever reason has failed to enter the gates of finance.
So if you're an SD analyst or a support person, this is your morning routine: coffee and VFX3.
It has to be. You run VFX3, you see the list of stuck documents, and you check the error messages in the log. Account 12345 is locked for posting, tax code V2 is missing, posting period is closed. If you don't clear this list daily, your company's revenue is theoretical, not actual.
Theoretical revenue. I don't think shareholders or the board are particularly fond of that term.
No, they generally prefer the real kind that you can, put in the bank.
Let's pivot a bit. We've talked a lot about the money. Now let's talk about the law. This brings us to segment 2, taxes and credit management.
The fun stuff, where mistakes get really expensive.
Let's start with taxes. In a global setup, this gets complicated incredibly fast. The source material we reviewed calls the logic a triangulation. What does that mean?
It is. It's the perfect word for it. The system can't just look at the customer and say, this customer is in a 5% tax jurisdiction. It's not that simple. It has to look at 3 key pieces of data simultaneously.
What are they?
First, the departure country. Where are the goods physically shipping from? Second, the destination country. Where are the goods physically arriving? And third, the tax classification of both the customer and the material involved.
That seems like a lot of variables to get right every time.
It is. And the who goes where logic is absolutely critical. Let's take a simple example. You are shipping a product from a warehouse in France to a customer in Germany. Is that an export?
Yes, it's crossing a border.
Okay. Is it tax exempt?
Maybe. I'm not sure.
Exactly. Maybe. It depends. If the German customer has provided a valid VAT registration ID, then yes, it's an intra-community supply and it's taxed at 0%. But if they don't have a valid ID or you don't have it on their master record, you have to charge them French domestic VAT. The system has to make that decision in milliseconds for every single order.
And if it makes the wrong decision?
You have a compliance audit and you owe the government back taxes plus penalties. The most common error I see is when the system fails to recognize that a transaction is an export. It sees customer in Germany, but for some technical reason, the destination country field in the pricing logic defaults to France. So it charges domestic French tax when it shouldn't have.
How would you even begin to debug that? That feels like it's buried deep in the code somewhere.
It is. You can use the standard pricing analysis in the sales order, and that can give you some clues. But often that's not enough for complex tax scenarios. The expert move, the real deep dive technique, is to set a breakpoint in the function module pricing load condition record.
Okay, that sounds pretty intense. That's a developer's tool.
It's surgical, but you don't have to be a developer to use it. You can learn how. You stop the system right at the moment it's trying to find the tax rule. Then you can inspect the values in the communication structures. You look at two specific fields, KOMKA land, which is the departure country, and KOMK land 1, the destination. If those two fields are identical when they should be different, you found your problem. You know your master data or configuration is passing the wrong geography to the tax engine.
Okay, let's look at the other side of the legal coin. Not paying taxes, but managing risk. Credit management. Stopping us from selling to people who are not going to pay us.
And this is a huge area of friction, a constant battle between the sales department and the finance department. Sales wants to sell, their commission depends on it. Finance wants to block any sale that looks even slightly risky.
The sources we looked at mention a really interesting phenomenon called phantom exposure. It sounds like a ghost story for accountants.
For a sales rep trying to hit their quota, it is. Here's the scenario. You have a good customer. They have a credit limit of, say, $100,000. They've been a bit slow to pay, so they've used up their whole limit. Then they send a big payment. Their balance is now 0.
Okay, so they should be good to go.
You'd think so. The sales rep tries to put in a new order for just $5,000, and the system blocks it. Hard stop. Credit limit exceeded. The rep is furious. They paid. Their balance is 0.
But they paid, so why is it blocking?
They did pay. But the system is hallucinating. It's seeing ghosts. In the background, there are these special tables. The technical names are S066 for open orders and S067 for open deliveries that track the total credit exposure.
So they store the value of all the unbilled orders and deliveries.
Exactly. But sometimes, due to a system glitch, a bad program update, or just messy processing, those tables don't get cleared properly when an order is finally billed and paid. So the system still thinks there is $100,000 of open orders sitting there, consuming the credit limit.
So the debt is a phantom. It doesn't exist on the customer's account anymore, but it's haunting the credit record.
Correct. It's a ghost in the machine.
So how do you exorcise the ghost? Is there a special transaction for that?
There is. You have to run a special report. RVKR 77. In the newer S4 HANA systems, the name has changed slightly to UKMRVKR 77, but it does the same thing.
Is it really that simple? You just run the report and the problem goes away?
Well, here's the big red warning label. You absolutely cannot just run this report whenever you feel like it in the middle of the day. This report locks the credit tables.
Meaning what exactly?
Meaning if you kick this off at 2:00 p.m. on a busy Tuesday, nobody in the entire company globally can save a sales order or create a delivery until it finishes. You will bring the entire sales floor to a dead halt.
Oh, wow. So this is strictly an after-hours or a weekend fix.
Strictly. It has to be planned with the business. What it does is it completely rebuilds the credit exposure from scratch. It reads every single truly open document in the system and sums them up again, correcting the corruption in those S066 and S067 tables.
While we are on the topic of credit, let's talk about update groups. The source material mentions a very specific one. Update group 00000012. Why does that specific number matter so much?
This is all about timing. The update group configuration controls when the credit exposure value actually increases. At what point in the process does a sale start counting against the customer's limit?
Okay, that seems pretty important.
It's critical. If you pick the wrong group, you might have a setup where the credit exposure only updates when the invoice is created.
That seems way too late.
It's dangerously late. The goods have already been picked, packed, and are on the truck heading to the customer by that point. You want the exposure to update the moment the sales order is saved. That's what Update Group 12 usually does. It ensures the exposure is updated for the open order value, then it adjusts for the open delivery value, and finally clears it at open billing. It tracks the entire life cycle.
So if you mess this setting up, you are basically giving away free credit until the invoice is finally cut.
You are. Your credit check is effectively blind to all the orders that have been placed but not yet invoiced, which could be a massive amount of risk.
Let's move on to segment 3. We've covered the standard money and law stuff. Now let's talk about the weird stuff, the not standard processes. We're looking at third-party, returns, and output.
The exceptions to the rule. This is where the standard order to cash flow gets twisted into new shapes.
Let's start with third-party sales, or TAS. This is essentially drop shipping, right?
Yes, that's the modern term for it. We sell it, but we don't own the inventory, we don't store it, we don't touch it. A vendor ships it directly from their warehouse to our customer.
So it's not a simple process. It's a chain reaction.
It's a very delicate daisy chain of documents. The sales order is saved in our system. That action should automatically trigger the creation of a purchase requisition, or PR. Then, ideally, that PR automatically converts into a purchase order, a PO, that gets sent to the vendor.
What happens when that chain snaps? Where's the weak link?
The most common failure point by far is that the sales order saves, but the purchase order is never created. The sales rep thinks everything is fine, but the vendor never gets the instruction to ship.
Why does that happen?
Usually because the system doesn't know who to buy the product from. For that automatic conversion to work, you need master data setup called a source list and an info record. If you haven't explicitly told the system, always buy widget X from vendor Y at this price, it creates the requisition, but then it starts. It can't guess the vendor. It needs a human to intervene.
And there's a special billing block that's peculiar to this third-party process, right?
Yes. Think about it for a second. In a normal sale, we create the invoice after we create the delivery and post-goods issue. That's our trigger. But in a third-party sale, we don't do a delivery. So how do we know when it's okay to bill the customer?
I guess when the vendor tells us they've actually shipped it.
Exactly. Or even better, we wait for the vendor invoice. The item category TAS is usually configured with a billing relevance of F. That code means bill the customer based on the quantity from the vendor's invoice receipt.
So we can't bill our customer until we've processed the bill from our supplier.
Correct. It's a crucial safety check. You don't want to be billing customers for things that your vendor hasn't even shipped yet, but it can frustrate the finance department because they see the sale and want to book the revenue immediately. But you have to tell them we have to wait for the vendor paper.
Now let's talk about returns, the unhappy path of the sales process.
Unhappy, but necessary. And returns are dangerous from a system perspective because you are bringing inventory back into your building and giving money back.
The source notes a very specific risk regarding how that inventory is valued. It's about movement type 651 versus 653.
This is a classic consulting debate, and getting it wrong has big financial implications. When a customer returns a product, it's often damaged, it's an open box, or sometimes it's just garbage they put in the box.
Right. It's not in a sellable condition.
Probably not. If you configure your returns process to use movement type 653, the system takes that returned item and puts it directly into your main unrestricted stock.
Which means it's considered good stock.
Yes. Instantly, your inventory asset value on your balance sheet goes up, and the system thinks this item is perfectly fine and ready to be sold to a new customer.
That sounds disastrous. You could accidentally have your warehouse pick that broken unit and ship it out to a brand new customer an hour later.
It happens all the time. That's why you should almost always use 651 for customer returns. That movement type puts the stock into a special category called return stock. It is non-valuated. It sits in a digital quarantine zone. It doesn't affect your inventory value until someone from quality control physically inspects it and makes a decision to either scrap it or move it back to good stock.
So the rule is avoid 653 unless you are absolutely 100% sure the goods coming back are pristine.
Precisely. And you rarely are.
Okay, let's touch on output management. This is how the system talks to the outside world, generating PDFs, sending emails, printing physical documents.
The shift from the older ECC systems to the new S/4HANA is huge in this area. It's a completely different technology.
So the old world was transaction NAST.
NAST was. Well, it was predictable. You had your output types, your access sequences, and you had requirement routines. For example, a very common one was requirement 62. This was a little snippet of ABAC code that said, do not print or email the invoice until it has been successfully released to accounting.
Which makes perfect sense. Don't send a document out that isn't official yet.
Right. It was a good control. But in S/4HANA, NAST is being phased out. The new world is BRF plus arson. That stands for Business Rule Framework Plus. It uses these complex decision tables that you maintain in a transaction called OPD.
Is it better? Is it an improvement?
In theory, it's more powerful and more logical for a business user to maintain. But it has what I call a silent death problem.
The silent death problem.
In the old NAST world, if an output failed, you usually got a red light in the processing log. It would tell you requirement 62 not fulfilled. In BRF Plus, if you miss a condition in your decision table, say, you forget to define which PDF form template to use for the French language, the system doesn't throw an error. It just Does nothing.
Lists you.
It completely ignores you. You save the invoice and you think an email went out, but nothing happened. No error message, just silence. You only find out 3 weeks later when the customer calls and asks where their invoice is.
So you have to be extra, extra rigorous in testing the decision tables.
You have to test every single combination of columns and rows, or you'll have these silent failures lurking in your system.
All right, let's move into our deep dive segment 4, the advanced toolkit. These are the master data tricks and controls that can really make a difference.
Yeah, these are the tools that, when used correctly, make you look like an absolute wizard to the sales team.
First up, material determination. It sounds a bit dry, but the notes say it's actually a powerful sales tool.
It's automated substitution. It's really cool.
Like the classic, we're out of Coke, is Pepsi okay at a restaurant?
Exactly like that. But the system does it for you automatically. A very common use case is the version up. You launch the new iPhone 16. You still have the iPhone 15 in the system as a material number. If a customer service rep, out of habit, types in the old iPhone 15 number, you can set up a rule using reason code 0002 that automatically swaps it for the new iPhone 16.
So it prevents people from ordering obsolete products.
Yes, and it can be used for promotions too. For the month of December, if a customer orders the standard holiday pack, automatically substitute it with the deluxe holiday pack. You can set it up for a specific date range, and it handles the upsell without the rep having to remember anything.
Next on the list, listing and exclusion, whitelists and blacklists.
These are powerful controls. Listing is very strict. If you create a listing for a particular customer, they can only buy the specific items that are on that list, period.
Where would you use something that restrictive?
A great example is in pharmaceuticals or chemicals. A hospital might only be licensed by the government to purchase certain controlled substances. With listing, you can ensure they can't even accidentally order something they aren't authorized to have. This system will see it's not on their approved list and block the order line.
What's the danger with this one?
The danger is if you activate listing for a customer, but then you forget to actually populate the list with any materials.
They can't buy anything at all.
You've just shut down the customer completely. An empty whitelist means nothing is allowed.
And then there are BOMs, bills of material. This is where the sales world meets the production and engineering world.
And this is where they usually fight. The way sales wants to sell a kit is often different from how manufacturing wants to build it.
The source material mentions 2 specific pricing codes that sound like a weird comedy duo from the 70s, LUMF and ERLA.
Chuckles. They do,
Yeah.
but they're incredibly important because they define how you bill a bundled product or a kit.
Okay, break them down for me. What's LUMF?
LUMF stands for pricing at the component level. Think of a build your own PC bundle. You sell a kit that includes a monitor, a tower, and a mouse. On the sales order and the invoice, the main line item, the computer bundle, has a price of $0. But underneath it, the monitor is priced at $200, the tower at $800, and the mouse at $20. You place the individual pieces.
Okay, so what's ERLA?
ERLA is the opposite. It stands for pricing at the header level. Using the same example, the main line item, computer bundle, is priced at $1,020. The monitor, tower, and mouse are listed below it as sub-items, but they all have a price of $0. They're just informational.
Why does this distinction matter so much? It sounds like an accounting detail.
It's a huge detail for inventory valuation and especially for profitability analysis. In the ERLA scenario, all the revenue and profit sits on the header material, the bundle. In the LUF scenario, the revenue and profit are spread across the individual components. If your marketing team wants to know which component is the most profitable and you use ERLA, you can't tell them. Your product line reporting will be completely wrong if you pick the wrong one.
Okay, final segment. This is for when everything else fails. Segment 5, the mechanics corner. Technical debugging.
This is for when the configuration looks correct, the master data looks correct, but the system is still broken.
Let's start with a classic. Authorization issues. A user calls the help desk and says, I can't create the order, the system won't let me.
And the first thing that everyone, absolutely everyone does is run transaction SU53.
And I have a feeling you're going to tell me that's the wrong thing to do.
It's not wrong, but it's often a lie, or at least a partial truth. SU53 shows you the last failed authorization check that occurred. But often, the real meaningful failure happened 10 steps earlier in the program's logic. The program might have caught that first failure, handled it silently, and then failed on something completely different and irrelevant later on, which is what SU53 shows you.
So what's the real tool for the job?
The real tool is ST01, the system trace. You turn on the trace for authorizations for that user, have them repeat the action, and then you review the log. It records every single permission check the system makes in real time, success or failure. It doesn't lie.
And that catches the custom stuff too.
That's the other C. You can also set a breakpoint in the code at the command authority check. Sometimes a clever developer has written a custom check inside a user exit that says something like, if the user is Bob, don't let him sell to our competitor Apple. SU53 will never show you that clearly. The trace or the breakpoint will reveal the hidden logic.
Next up in the mechanics corner, number ranges. We come back to the case of the missing invoice number.
We touched on this in the intro. You have invoice 101, then 102, then suddenly the next one is on a 5, gaps in your invoicing.
And you said this is a huge legal problem in some countries. Why does it happen?
It happens because of a feature designed for performance called buffering. To make the system fast, the application server doesn't ask the database for a new number every single time. Instead, it grabs a chunk of numbers from the database, say numbers 100 to 110, and keeps them in its local memory, its RAM.
Okay, that makes sense. It's faster.
Much faster. But let's say the server crashes or restarts for maintenance after you've only used number 101. What happens to numbers 102 through 110 that were sitting in memory?
They're gone, just erased.
Gone. Poof. Vanished. The next time the server starts up, it goes back to the database and says, I need another chunk, and the database gives it 111 to 120.
And suddenly you have a permanent, unexplainable gap in your legal document sequence.
And the auditor comes and asks, where are the invoices for 102 through 110? Did you sell things off the books and hide the revenue? It's a very serious question.
So in countries like Italy, France, or others where this is strictly illegal, what do you do?
You have to go to Transaction SNRO, find the object for billing documents, which is RVBE leg, and you must turn off buffering. You set the buffer size to 0.
Does that slow the system down noticeably?
A tiny, tiny bit. It means for every single invoice, it has to make a separate call to the database to get the next number. But it's a minuscule performance hit, and it's the only way to guarantee perfectly sequential numbering. It's a small price to pay for staying out of jail.
Agreed. Last technical tip from the notes. This is the classic lament of every IT project. Transports. It works perfectly in the development system, but it breaks in the QA system.
The classic developers cry for help, but it worked on my machine.
The source material points a finger directly at VOFM routines.
Yes. These are those copy control routines and pricing formulas we talked about earlier, the little bits of code that handle the invoice split logic or data transfer or special calculations.
So why do they break when you transport them?
Because they are strange hybrids. They live in the world of configuration, but they are also ABAP code. Sometimes when you transport the configuration entry for the routine, the system forgets to trigger the regeneration of the actual executable ABA code in the target system. So the rule exists in the table, but the program behind it is empty.
So how do you force it to regenerate?
There is a magic report you need to know. RV80HGEM.
RV80HGEM.
You run that report in the target system after the transport has been imported, and it forces a complete regeneration of all VOFM formulas and routines, making the code active.
And the pro tip, the real-life hack.
The real pro tip is to have your system administrators include this report in the transport request itself as an XPRA step. That means the report runs automatically in the background the moment the transport is imported into the new system. You don't have to remember to run it manually at 2 a.m. during a go-live weekend.
That is the definition of a life hack for an SAP consultant.
It saves so many panicked phone calls on go-live weekends.
We have covered an absolutely immense amount of ground today. We've gone from VKOA buckets to phantom credit debt, from intercompany reconciliation nightmares to the ghosts of missing invoice numbers.
We certainly have. It's a complex web.
If there's one big takeaway from all of this, it's that sales, in a system like SAP, is really just a gigantic series of logic gates, a flowchart with 1,000 branches.
And all of those gates have to open in the perfect sequence at the perfect time for it to work. One broken gate can stop the entire process.
Before we sign off, we have one final provocative thought, a final warning. A big red do not touch button in the system.
Yes, this is critical. We need to talk about the status tables, VBUK and VBUP.
The status tables, what do they do?
These two tables are incredibly simple but incredibly important. They track the overall status of the sales document header, VBUK, and each individual item, VBUP. Is it open, partially processed, in process, complete?
And the temptation is when...
The temptation is when a document gets stuck. You have an old sales order from 2 years ago. For some reason, the status says in process, but you know it's done. It's cluttering up your reports. You want to archive it, but the system won't let you because it thinks it's still active. So you get a developer to write a little script to go into the table directly and update the status field. Just force it. Change status A to status C.
And you're telling us, don't do it.
Under almost no circumstances should you ever do this.
Why not? What does it break?
Because the status is not a setting. It is a result. It is the final sign-off that is a consequence of the entire document flow working correctly. If you manually force the status, you break that fundamental link. You might get the orders to show as complete in your report, but the stock reservation for that order might stay in the system forever, or the revenue value might never post to your profitability analysis. You are breaking the fundamental integrity of the database.
So if a document is stuck, you have to find and fix the root cause. Don't just hack the scoreboard to make it look like you won.
That is the perfect analogy. Fix the problem, don't just change the report. Data consistency is the ultimate currency in these systems. Once you lose it, it's almost impossible to get back.
That seems like the perfect place to wrap up this deep dive. Go check your VKOA settings, turn off number range buffering if you're in Italy, and for the love of everything, try not to use that general entry trap unless you absolutely have to.
And please, for your own sanity, use the split analysis tool.
And use the split analysis. Thanks for listening to this deep dive. We'll catch you on the next one.